I am. Thanks very much for the opportunity, guys. Good to be visiting with you all by Zoom again. Kevin and Michael, thank you all very much for the opportunity.
Yeah, absolutely.
Ernest, it's great to have you back. And I look forward to hearing this conversation today. Hopefully you can see my screen.
I can. You've got us looking good. We paled by Michelle, but we'll just do the best we can here.
All right, Ernest, it's all yours.
Well, great. Hey, everybody, thank you all very much. We have a great panel today speaking on our topic, housing and inflation, what's around the corner. Seems every time I pick up a newspaper, turn on my iPad or my computer, there's some article popping up about inflation, trying to define it and understand it. And inevitably, it leads to a conversation about housing and of course, the housing crisis our country faces. So today, the objective of this panel is, one of my favorite economists is Dr. Mark Dotzer from Texas A&M University. And one of his favorite sayings is, whenever you discuss the economy, there's a 50-50 chance you're right. So, we're going to keep going with those odds that what we're speaking today is not in absolutes, but just the observations of people who have been in the housing industry for a very long time, or in Michelle's case, has been working with advisors and teaching finance and studying the world of inflation for a number of time. Before I introduce the panel, I'm just going to real quickly review the topics that we're going to cover. Basically, looking at inflation, is it transitory, or is this what we see in terms of historic inflation? Is real estate, and especially multifamily, still a hedge against inflation? How is real estate going to impact the different real estate sectors? Talk about input cost, that is material cost. Is there an end in sight to these rising prices? Does multifamily properties offer a solution to the shortage and affordability crisis facing the housing consumers in the country? Where do we fit into the investment portfolio during inflation in terms of real estate? And then, if we have time, some random conversations about the impact on interest rates and the labor market. So with that, I'll begin to introduce myself. I'm Ernest Johnson with ApexOne Investment Partners. I'm Executive Managing Director. I've been in this business quite a while, longer than I'd care to admit. At ApexOne, we've now launched our fourth fund. Been very pleased with our results. We've had about 94% of our investors stay with us through all four funds, which is one of the highest rates in the industry. And we've achieved what I think are outstanding results. In fact, over 28% on our full cycled properties. And speaking of full cycled property, I'd like to introduce Tim Burns, my partner, who's also an Executive Managing Director at ApexOne. He's our Chief Investment Officer. He's the one responsible for those returns. Tim and I knew each other from our days at JMB and Heitman. And Tim, why don't you take a few minutes and introduce yourself, or take a minute.
Yeah, thank you, Ernest, and good afternoon, everybody. I appreciate everybody being on the call. And as Ernest mentioned, we go way back to the 80s in our days at JMB, and then the 90s at Heitman. And so we've been around for quite a while. We launched Apex a little over 10 years ago with the intention of kind of following the model that we had followed in our careers, and we've been lucky enough to have a fund series launch and grow it, and we put together a really nice team at Apex, and we have great partners like Mike Price and Balfour and a few others. So we're pretty pleased with what we've done so far, but hopefully have a long runway to go still.
Thanks, Tim. This time I'd like to introduce Michelle Connell, who's recently joined ApexOne as one of our economic advisors. We have a number of economists that we keep on retainer to study not only the housing markets, but what Michelle is bringing to us. She's a frequent speaker on national syndicated radio and television business channels, and she has a much broader view of the economy and how real estate can be impacted by a lot of different sectors. So Michelle, first, welcome to ApexOne as one of our economic advisors, and tell us a little bit about your career and yourself and what you're doing.
Thank you, Ernest. I've been in the business, like Ernest, a long time. I've had my CFA since 1998. During that period of time, I worked in private equity, private debt, as well as on the institutional side of managing money for several mutual funds. Currently, I have my own firm in the Dallas-Fort Worth area. I have a focus on foundations and charities and high net worth individuals. I allocate fair amount, usually 20 to 25%, to areas such as private equity, private credit, and a lot to firms such as Ernest in the private real estate world.
Well, Michelle won't mention it, but I'm one of the great stories that Michelle told me when we first met was when she was a professor at a small college up in northern Louisiana. She put a team of students together in a financial competition and ended up going against the big boys at Harvard and Yale's and some others. And she smoked them, and her team from Little Louisiana beat them all. So she undersells her abilities, but she takes on the big teams all the time and does well. So Michelle, great to have you on.
Thank you.
At this time, I'd like to introduce Mike Price. One of my mother's favorite saying to me and my two brothers was, people will judge you by the company you keep. And we're in pretty good company. Balfour Beatty has been one of our partners. Mike, I think we've now partnered in over 20 deals nationwide in the 8 years we've been working together. Always a pleasure to be working with the team at Balfour Beatty. And Mike, why don't you tell us a little about yourself and Balfour Beatty?
Sure. I've been with Balfour Beatty for 14, going on 15 years now, and in various roles. But Balfour Beatty is investment, construction, and owner operator. And the owner operator generally focuses on multifamily and student housing. And our predecessor company, GMH Communities Trust, was at one time the largest student housing owner operator in the country. So we go way back in kind of the multifamily and student housing space. And to Tim and Ernest credit, we formed a relationship, I think 8 years ago. One of my colleagues met you guys at a real estate conference, and we invested in our first deal, I think about 6 or 9 months later, and we've done 15 to 20 since then. So happy to be here.
Well, it's a pleasure. Again, Mike won't brag, but something I'm very proud of, they manage a good number of our properties, and their management company was recently ranked number 9. That's not just by size, but also on the quality of service they provide to residents. And that number 9 is out of the several thousand companies that provide those services nationwide to apartments and multifamily projects nationwide. So Mike, congratulations on that. We're pleased to be a part of the Balfour Beatty team. So let's jump right into it. I know everybody's eager to jump off and jump on with this topic. So Michelle, let me throw the toughest question to you first. So regarding inflation, how much of the price increase we see today are temporary? And is the price increases we're seeing due to production shutdowns over the last 14 months resulting in a shortage of goods and materials? Or how much of this is actual traditional inflation as we typically tend to think about these things?
I'm going to say it's a factor of both, Ernest. I think it's part temporary, and unfortunately, I think some factors of it are permanent. On the temporary side, I think that would include the supply bottlenecks that we're seeing, the commodity shortages that we're seeing. Also, for example, especially important towards housing is the lumber that everybody keeps speaking about. The fact that that particular commodity is up at least 180% since last April in 2020. Copper is up, which is used a lot in housing as well. I think those particular parts of or components of inflation are transitory, but I do think there's some areas, specifically wages and housing, that could be more permanent in nature.
Great. Tim, do you have any thoughts? I know we've discussed inflation in real estate quite a bit. What do you think in terms of the overall inflation picture right now?
Well, I think it's running rampant. It's not only the inputs that Michelle talked about, but it is wage. There's a lot of inflation. I actually think it may be being underreported right now. And whether it's transitory or not, I think is TBD. But as I've mentioned in the past, and I think this inflation has been around quite a while, it's showing up now. It likely is accelerating for some period of time. And whether it's transitory or not, I think a lot of folks are missing what it means, because if we inflate beyond where we want to for some period of time, whether it be 6 months, 12 months, 24 months, or longer, it doesn't deflate back down. And so that inflation becomes embedded in the economy, and it's not real good for the overall population.
Hey, Mike, as a big company with a lot of employees, how are y'all seeing inflation affect your properties in terms of cost of goods that go into those properties, wages and things like that? Are you seeing some of that? Have you felt some of that? Or are y'all anticipating some of that for the coming year?
We are seeing it. I think one of the bigger things that we're seeing at the moment is, and I think it's being reported on a number of levels, depending on who you listen to, is on the wage side and getting employees at the properties and doing the work, kind of the wrench turner work that we need to be done at properties. There are shortages there of finding folks to perform those jobs. So we are seeing it at the property level, and obviously on the construction side, we're seeing just the price fluctuations on that side of things, up and down the supply chain really impact delivery. Finding folks to do that construction work, et cetera, up and down the supply chain. I think that's been the biggest hurtful piece so far on the operational side.
Michelle, I'm going to put you on the spot. This isn't a question we discussed, but you sent an article this morning where the feds are, it sounds like they're trying to tamper down the talk of inflation. Do you think that, I guess it's kind of a tale of two cities. I see the government putting a lot of money into the economy, which tends to drive up inflation. But then I hear the president of the feds from Chicago saying, hey, wait a minute, it's not as bad as the press is making it out to be. How do we manage these two conflicting messages we're hearing?
I think we know intuitively as consumers and investors what actually is going on. Referring back to what the previous gentleman just said, we can see what's going on, in our companies and for consumers. It is rampant to some degree. And then we have the Federal Reserve and the banking community that wants to, keep things controlled and wants to make sure that they don't create any panic to some degree. So they're going to telegraph a certain message until they feel that they want to increase rates. I'm talking about the Federal Reserve, and or quit buying bonds on a monthly basis. And the Fed did kind of allude to that last week, that they're going to stop supporting their bond purchases. So I think we're going to start seeing some communication from them that says that they're in agreement with what's going on for the consumer and the general population, but they're going to take their time doing that because they don't want to disrupt the bond market and thereby the equity market.
Okay. Thanks, Michelle. Tim, traditionally, real estate has been considered a hedge against inflation from an investor's point of view. Do you think it'll continue to be a hedge if inflation continues for a longer period of time? Do you still see it as a hedge?
I do, but I think it makes a difference of which real estate you're pointing to. Multifamily and single family housing has generally been a better hedge than longer term lease type assets. Office or retail with 5 or 10 year leases may not be the beneficiary that multifamily or single family, which we're seeing, by the way, right now. We're living it, seeing where the valuations are and where the rents are in multifamily are headed right now. It's really, really strong and really, really high. So yeah, I do believe it's still a hedge, but I think you have to be in certain types of real estate to take advantage of it.
Mike, what are your thoughts on that topic?
I mean, we view it as the same. Obviously, multifamily lends itself to the being the more flexible and resilient. I mean, I think we have real world experience just over the past 10 to 15 years with one recession and the COVID impact. So from a downward economy, we've kind of seen the effects on the various sides, and being able to daily price in multifamily and 6, 9, 12-month leases in multifamily all lends itself to being resilient. But I also think within multifamily you kind of have stratas of locations and asset classes that will also perform better and worse. I mean, we've seen the gateway cities versus the secondary cities and the tertiary markets perform differently in those inflationary periods as well. So I think there's even stratas within the multifamily.
Michelle, you have any thoughts on real estate and its hedge against inflationary times?
It has been a hedge back into the feudal days of Europe and England. So I don't think that's going to change given where we are at this particular spot in time. But I would also agree that as in the past, it was easier. You could just put your money in REITs if you wanted to do something on the publicly traded side, or if you want to do something on the private side, you could put it into pretty much any area of real estate, and that worked. I think we're also going to have to be more selective, and I think housing is going to continue to do well, whether it's single or multifamily, and especially multifamily as less people are able to afford homes. With what we're seeing, homes going up 20% just in the last year and over 40% in the last 5 years. I think housing and multifamily will do well, and also some areas that involve data storage for the build out of infrastructure. So I think those two areas look really good.
That's a good lead into my next question, Mike. So one thing different about the 2020 COVID-19 recession as it pertains to real estate is this is the first recession that I can recall, and maybe Michelle can take us back to the feudal times with her history lesson, that real estate was not in an oversupply position, especially in multifamily. I mean, we're still, depending on who you listen to, between 3.5 and 4.2 million housing units short in this country. And so, we don't seem to have been as impacted, but what are you hearing and what are you seeing about the other different sectors of real estate, like retail, office, hospitality, et cetera, Mike? What are your thoughts on those?
Yeah, I think obviously, multifamily has become the darling, and I mean, just we're living real world experience within our firm, from choosing office space and what that looks like in the future. If we do head towards a more inflationary situation, obviously the hotel and hospitality, that depends on disposable income, both at the personal level and the corporate level. And then obviously retail has been going through a tough spiral even pre-COVID. So I think, when you kind of look across that and what we're seeing on the construction side of things and orders and what folks are bidding on the construction side, everything still points towards multifamily, really because of that overarching statement you said at the beginning, is the housing shortage across the country kind of rules all at the moment. And even in this time of lumber prices increasing, all of those developers and construction companies are still extremely busy and taking orders and building product. I read something like 45% of the construction projects that are 50 million and up are multifamily. So it's the darling right now on that side of things.
Michelle, you have any thoughts on the different real estate sectors and how inflation is going to impact them, consumers, how they're going to use maybe shifts in consumer taste in retail, or what are you seeing and hearing?
I think that there will be some areas of retail that will do well. Obviously we've had a large number of closings of retail properties, as well as bankruptcies of several retail organizations during the pandemic. But the areas of retail that have done well are those that are specialty, that are more high-end in nature, and or those that can provide an experience, especially for younger consumers, who are used to doing business online, they want something that they can, experience and spend their money on that versus just a good or a service. So I think that will affect retail. It will also affect hospitality, which hopefully will get online sooner versus later. And I think we're also going to see a continued change of the on the office side. There are some large organizations like JP Morgan in New York. They probably will stay at home a large part of their employees for a while, and or they'll stagger them. So I think that's going to leave an excess of certain pockets of commercial real estate that will probably not feel, or they won't participate in the upside or the capital appreciation that housing and multifamily will.
Michelle, I'm going to loop back to you on something you mentioned about Willis about using office space. But Tim, I wanted to get you to weigh in. I know when you're at JMB and Heitman, you work in a lot of sectors, not just multifamily. And what do you think about the impact of this recession on and inflation on some of the other sectors of real estate?
Well, I agree with what others have said and what I said a few minutes ago, and that it does make a difference on what type of real estate you're analyzing. And clearly, in the past, and in my opinion, going forward, there are certain pockets that are going to do much better, and multifamily and housing is going to be one of them. Going back to what you mentioned or Mike mentioned about the shortage of housing units, that is likely even going to be exacerbated by this inflation that we're in. We're hearing anecdotal stories of developers who are just stopping their multifamily projects and not building them right now because the costs are so out of control. They don't know what it's going to cost, and whether they're going to make money. So it is happening. It seems to be accelerating, it'll be interesting as it unfolds.
Michelle, getting back to you just on a side note, you mentioned something about people rethinking the way they use office, and of course, that can have an impact if cost goes up. And is it cheaper to have people work at home? You are still teaching a lot of young people coming through your organization. You're putting them into good places. Don't they feel a desire? Don't they want to be in that office environment for a while for the learning and the sharing and the knowledge that's there? Isn't it hard for them to just suddenly set up shop and open their computer and be at work one day? What are they telling you? What do they expect?
I think that there's a part of the younger worker as well as us, that's a little bit more seasoned. We like being around people. There's more synergy when you have a team around you versus getting on Zoom calls and in between hanging out in your kitchen with your kids and your pets. That's not going to do it in terms of providing that team atmosphere. And so that's why you're having, I deal a lot with investment banking firms and with asset managers. They're trying at least to have overlap with a lot of their employees, during the work week, so they can have that synergy and that teamwork, because that's really important for a company that, you don't feel like you're a lone wolf out there trying to, meet your goals and objectives, but that you're working with, your fellow teammates.
Okay, so my next question, I'm going to split it. First, I'm going to ask Michelle to comment from a consumer's perspective on housing and inflation, and by housing, I include multifamily in there. And then I'm going to ask Tim and Mike to jump in relative to from an investor standpoint in terms of what people that are out spending the money and trying to provide returns to investors are looking at, and how some of these factors may impact. So Michelle, first, so in our industry, some of what we talked about earlier, the input costs have seen dramatic escalation. I'm not sure how much lumber's up. I've seen a low of 180. I've seen as high as 300. I think those scales depend on the type of lumber. I know fine finished lumber for millwork is very expensive right now, whereas maybe the basic 2x4 isn't quite 300%, but it's up there. Steel is up 17.6% in March alone. Gypsum, or drywall as most are referred to it, is up 2.1% in March. Millwork's up 13% in a year. And this is obviously driving the price of housing up. And a statistic that I saw through one of the groups you work with, Yahoo Finance, stated that for every $1,000 increase in the price of a home, 150,000 potential home buyers are priced out of home ownership. That means last year alone, about 7.8 million people were priced out of home ownership because of the increase in housing. So the question to you, Michelle, do you expect these prices to keep going up? And what does that mean for home buyers and renters? Even if they don't go up that much, how much is this really impacting home buyers and renters in terms of their housing cost?
I think it's affecting whether you are renting or buying. It's affecting all consumers, that need some sort of housing. I think when I looked at a statistic earlier today, for the average American, they spend about 35% of their income on housing, whether it's in the form of rent or a mortgage. So when you have a home increasing in value 20% in 1 year, and you're an average American, that means that something that you were looking at a year ago is way out of your price range, or you're looking at something that really is not great in terms of housing. I've seen a lot of houses that are $500,000 in the Dallas-Fort Worth area, and you're like, I wouldn't want to live in that $500,000 house. So we're getting into that situation where the consumer is going to say, do I really want to buy this home that is this expensive with this type of liability over my head, or am I going to rent until things stabilize a bit, or I can regroup and figure out, is there a better part of the country or in my area, my metro area, that I want to live, that's more reasonable? And I think a lot of families are going to be having that discussion. I don't think prices are going to continue to go up the way they have. I think somebody talked about the current shortage. That shortage is continuing because homes aren't being built fast enough. I think we're going to continue to see increases, but probably closer to the historic side of 4 to 6%, at least in the near future, God willing.
It's funny you had mentioned the story about the house that costs $500,000 and you scratch your head like, would I really want to live there? I can't tell you the number of deals that Tim and Mike and I see of, quote, value add real estate, and it's something built in the late 60s. And I think Tim made the comment, the only value there would be if it burned down. It's just amazing what they're trying to push, some of these prices, because it's such a hot market out there. But Tim and Mike, taking the components of the previous question into account, where Michelle discussed the impact on home buyers and renters, from an investor's perspective, during these times of rising cost, what solutions can the multifamily industry offer into the shortage and affordability of housing? It's also costing more to build multifamily housing, obviously. But there are certain economies of scales, and there's things that do benefit the economy, the environment, cities by building multifamily properties. But before we jump into that too much, Mike, Balfour Beatty is one of the last number I saw is one of the 10 largest construction companies globally, the largest or one of the largest in the UK. What are you hearing from your construction side of the business regarding construction cost in the U.S., especially as it pertains to the multifamily sector? How much are costs actually up?
Yeah, I think again, depending on who you talk to, but I think the most recent commentary when I spoke to some of my folks, who just lumber alone is about 260% as of last week, year over year, and it's literally been fluctuating on a weekly basis. I think the week before that it was close to 300, so it's actually come down over the past week or so. It's pretty amazing what it's done from a demand standpoint. Is it's increased competition on the really strong developers, kind of the A+ developers, who are pushing forward with projects, and those are still getting built, and construction starts are still moving along, and really what it's done is it's squeezed margins really up and down the delivery chain. And I think developers still are pointing to, that housing shortage, and the rental demand that continues to push, and that, they really look at it on a risk adjusted basis, that they can achieve the rents even with the increased costs, and continue on with their projects. So that's been really the commentary, that, there's so much competition on the subcontractor side, that it's eaten away at a little bit of the material costs, and then developers are just underwriting from that perspective based off of the housing shortage and demand.
Hey, Tim, taking into account what Mike was saying, and I know you work with a lot of developers because you're buying a lot of properties in Fund 4 directly from developers that are having some kind of stress. What are you seeing? What are your expectations, in terms of how these rising costs are impacting those builders, and what they're having to do now to secure, their forward-looking obligations they have? Maybe comment on what you're seeing in the market right now in terms of activity.
Well, the projects that we're buying in Fund 4 they've already been built. So they did not go through necessarily this inflationary period because they're in lease up, and that is all behind them. So they have done fine. What's happening, they're trying to exit as fast as possible for various reasons, and pricing is pushing up on those, on the sale of those transactions. But what's more important for us as we're buying those, we're seeing what's happening live on, and we're mostly in the Southeast, so it maybe is a little bit different than some other areas, but we're seeing live what's happening with rents, and all of the projects that we're buying, the rents are escalating at an unbelievable pace. So, the developers are doing fine getting out for the projects that are built. The buyers like us are seeing rents escalate beyond our pro formas. So we're kind of living this inflation right before our very eyes, and the renters and the users of the real estate are the ones that are ultimately paying the price.
So what is, maybe you and Mike can address this, separately, but, just for the people that aren't as involved in our industry, why is it more efficient to build multifamily than, why is it more efficient to build a 300 something unit multifamily project versus a 350 home neighborhood?
Mike,
Sure. Yeah. I mean, it's really about the economies of scale and the density, from a lower land usage, and really the number of people that you need to employ to take care of those. We have a large military housing portfolio that are single family rentals across acres and acres of a neighborhood, and it takes vastly more people, time, and energy to manage those as compared to a 300 unit garden style or even mid-rise multifamily. So, your operating costs kind of per square foot across the total project is, a fraction of that of a kind of single family neighborhood built product.
Tim?
Oh, I would agree with Mike. He's got it.
So Tim, maybe a question to you real quick is, so I think the last stat I saw come across the board the other day was the average home price in America right now is $360,000, and that's existing homes. I think the average new home is closer to $500,000. By contrast, what's the average construction cost per unit of an apartment complex, they say, maybe in like a Fort Myers, Florida?
If it's a garden, just typical garden, it's in the low 200s, 220, 240. So it's definitely more efficient. Might be slightly lower than that on the stuff that we're buying right now because it was built over the past couple of years. But yeah, it is more efficient to build multifamily from a cost perspective for sure.
So a question back to Michelle real quick. You've been on several television and radio shows and talking about the business news of the day. You're also working as advisor to several foundations and high net worth family offices. So what are your clients asking you relative to how inflation is affecting real estate and what it means to them as an investor? Give us the free advice you're giving your clients. What are you telling them? What are they asking you?
I am getting a lot of phone calls in the last month about inflation from my high net worth clients, as well as the boards of the foundations I work with. I think especially for the individuals that lived through the Jimmy Carter era, they remember well inflation. And I know it's hard for most people to fathom. I think if you bought a house in the the early 80s, interest rates were 17, 18%, right? So people still remember that specific period of time, and they want to make sure that what they have saved is going to help them make their goals and retain their lifestyle. And they don't want that eroded by inflation. So they want to know that their portfolios are hedged appropriately. So we talk about, having enough real estate in place, especially if it's a high net worth individual. They're able to do some, private situations such as ApexOne, or, when it comes to the bond side of the portfolio, staying really short in terms of maturities and having portfolios that have a lot of floating rate debt. And by the way, I also allocate to real estate debt that's floating for bridge loans. So I think there's some opportunities out there, and I probably should add on top of that infrastructure. And when I say infrastructure, I mean roads, bridges, airports, et cetera, water.
Right.
Those things are some great opportunities because utilities always participate in inflation. So having some exposure in your portfolio to that asset class is helpful, as well as real estate.
Great. A couple of questions we'll throw out here to the group. This is from Al. Says, given the comment that many multifamily developers are putting their projects on hold due to the inability to understand cost, how are you underwriting any future projects, especially lumber costs? Now, none of us are developers, Mike, and do a little construction, but I think, relative to, we do constantly examine these in terms of replacement cost. So Tim, and Mike, with these costs constantly moving, how do you determine what replacement cost is in a market, and how do you bake that into your equation when you're looking to buy a property?
Mike, do you want to take that, or you want me to?
You can take a stab at the first one, but yeah, I have some comments, sure.
So as we're underwriting and thinking about replacement cost, we're in the old days, when we were doing a little more value add projects, we wanted to obviously buy below replacement cost, but what we were hoping to do was also sell below replacement cost, 5 years down the road, and you feel like you're insulated within the market. We still view it that way, and I still look at what and we overlay the market value a little bit as well, and try to still escalate our future pricing at what I'll call, quote unquote, normal inflation, 2.5% or 3%. And we think that insulates us, even though I personally believe that prices are escalating much more rapidly than that. But we're still viewing it as a normal inflationary environment for underwriting purposes.
Mike?
Yeah, I mean, we look at it the same way, and it just kind of goes on our data board as a data point when we're evaluating a project to feel comfortable about, the going in and coming outside. And, obviously, with all of our experiences in the market, as much real-time live info to know, what land values and construction costs are happening in real time, kind of also goes on our board when we're evaluating opportunities. But it's definitely on our mind, even for existing products of, especially on the exit, whether we're below or above replacement costs.
Developers have to me, they're the most interesting people in our industry. They're certainly the bravest, taking on some of these challenges during inflationary times. I've heard from several sources that, general contractors and suppliers aren't guaranteeing material cost, over the period of time of a development cycle for an apartment complex, because they just have no idea. They can't get locked into something that they can't deliver on a timely and cost-effective basis. So, but I know there's been, situations, Tim, that we've benefited from where, buyers were, developers had some forward-looking commitments and, needed to sell at a discount to get out of a property, and they didn't have time to go through the cycle. But with that in mind, we had a question from Charlie, and Tim, he directed it at you, but we'll all comment. Regarding the anecdotal situation where multifamily developers are hitting pause midstream because they can't gauge cost increases and aren't sure they'll make any money, what are they doing next? Are they mothballing the project and carrying debt? Are they looking for buyers? Something else? What are
Well, I've heard of a couple of stories, and one of them, I think Ernest was in our office with Jim, where Jim is one of our partners, just by the way, of Ernest and I, where one of his developer friends in Houston just hit pause on his project and instead is investing in our fund. And I don't know I don't know who that person is. Jim just told me that was happening. So, and then when I've talked to some brokers as well out in the market that we deal with on a daily basis, they've seen and heard the same thing. So, is it rampant or long-term? Probably not, but it's happening.
Yeah, I think one of the interesting things about, the development cycle is that, and again, I say this with great admiration to developers, but they're a little bit like sharks in the sense that when they quit swimming, they die. And developers are always looking at the next project over the horizon. They've got a lot of forward commitments. And I know we ran into a situation, Tim, where we bought one project from a developer because he had some financial obligations. And for those of you that aren't aware of it, usually developers, and this is why I say they're the bravest people I know, they're on these big loans personally. So once they sign, they can't just shut it down. They've got to move forward. But once they have the money, they'll keep moving forward as much as they can. They can always scale back the size of a project. But we actually had a developer that had some forward-looking obligations. I had to sell one property, which we acquired at a significant discount. And then he realized he hadn't raised enough to meet his forward obligations. And he called and said, I have another property. If you guys are interested, I'll sell it to you at a pretty significant discount. We already have the documents. Let's just move forward. And so, we had a situation where he truly was a distressed seller, but it helped him meet his obligation going forward and to avoid the collapse of his personal collateral. So
well, and Ernest, let me just expand on that a little bit, because we're talking about all this inflation that is occurring right now, and the rents are accelerating. But what has happened with some of the developers is we did have COVID, and COVID put some serious pressure on the developers on their timelines, because it did shut down for a period of time. And as Ernest alluded to, they have obligations that have strict timelines, and that little shutdown for 9 months or 12 months really hindered their business plan. And that's where we've been able to step in, and we're going to be they're the beneficiaries of the inflation on pricing. They probably didn't get any cash flow. We'll be the beneficiaries of the accelerating inflation going forward.
Maybe jumping back on a couple of topics real quick here. Michelle, you seem to study inflation rates and interest rate increases and how they correspond with each other. What are your thoughts on the interest rate environment we're looking at? I know the Fed has some goals, but what are you reading and what are you projecting?
I think that interest rates are going to back up faster than we would like and the Fed would like, because the average inflation number, or their target of 2%, is probably going to come sooner versus later. So to believe that interest rates are not going to be increased by the Federal Reserve at their stated time somewhere in, after 2023, I think that's very optimistic. So I believe that interest rates will be higher. I'm not willing to say by how much, because I know that can come back and bite me. And my crystal ball is never very good on interest rates. It doesn't work for the Fed, so I don't think it's going to work for me. But I think, if you're somebody that is in the need for, getting borrowed funds, I'd be getting them now versus later. And I think we've enjoyed a long period of time of interest rates, especially investors, and every party must end.
So I noticed the 10-year treasury was down 160 yesterday. It just seems to be, it's like a little roller coaster ride the last few months. And do you think that's do you think it's still going to be a little roller coaster? But you're saying, Michelle, that you think it's the incline is still a little more up than I think in the past years it's been a roller coaster down, but you're sensing it's still going to be a little up and down, but headed up.
The trend this year is still, if you look at versus last year, the trend for interest rates is slowly ticking up, and I don't expect that to change. Do I think it's going to, the 10-year is going to be back over 3% in a long period of time, or a short period of time rather? No, but I think it's possible that things are going to, heat up, and the economy is going to continue doing well. People have a lot of money in their pockets, and the government is giving them more money, and that money has to go somewhere. And as things open up, more money will be spent. And last time I looked, that's called inflation.
That's the definition. We have a few minutes left. I think we've got the questions answered, either implied or direct. So I saw a real interesting story the other day that I told you I might bring up if we had time. It was in the New York Times, and basically the base of the story was that there's really not a labor shortage, just employers are not paying people enough to lure them back to work, which and the funny part of it is the photograph they were using under the headline of the story showed a McDonald's with a sign that says we're giving $500 signing bonuses. And so I'm thinking, boy, if there's, I guess I'm just not, I don't think there's a labor shortage. I think people are out there, and I know there's 8 million jobs available. I think I read that there's more jobs available now than any time in our history. But Michelle, do you think that driving wages up is going to bring people back to work, or is it other factors like fear of COVID or others that's keeping them away?
First of all, I think the New York Times article is not reflective of reality by far. I mean, just listening to you gentlemen talk about what you're experiencing in your industry, and trying to get good employees. First of all, Dr. David Kelly, who's the chief economist for JP Morgan Asset Management, he came out with a blog last week that showed that on a 2-year rolling basis since 2015, wages have increased every 2 years by 4%. Now, as of this April, that figure jumped from 4% to an 8% increase during that 2-year period of time. And his concern, I thought it was interesting, is that is what the Fed's going to have to focus on, that those wages are going to continue to feel pressure. And he also had another statistic that is escaping me at this time, but I think that 8% is very interesting. Oh, I remember the other one. The average worker or job seeker right now, their option of whether I take the job or not is $60,000. That's the figure where they say, do I stay on the couch or do I take the job? And $60,000 is a lot of money if you're, outside of the, East or West Coast. So I think it is a problem that we're going to be, dealing with for a while.
So one question final wrap-up question to Tim and Mike. So most of the periodicals I'm seeing regarding rents are showing, rent increases through next year and in 2023, getting into that 4 to 5% range. But then I read details on certain markets where they're talking 8 and 10% rent increases. Tim, I know you're not underwriting deals anywhere near those numbers, What are you and Mike underwriting acquisitions at in terms of reality versus what these inflationary rents could end up being?
Well, I'll take the first shot at that. And again, this depends on where your assets are, and we are generally located throughout the Southeast. So our numbers will be a little bit different than if you were in some of the markets that were more hit with COVID than we have been. We've been the beneficiary of it, but we are seeing rents increase like you just described, Ernest, 8%, 10%. There are properties that we have right now where we haven't found a ceiling on rents yet. It's happening on a daily and weekly basis. What we're underwriting is we are underwriting a little bit of higher growth in the first year or two. And that we're doing that because we're buying newer assets right now where they leased up during COVID, and they leased up, always during the lease up, there are concessions. That the developer's goal is to lease up as fast as humanly possible so we can sell the property. So we're getting the double benefit of they were going through a normal lease up and they were COVID. And so we're seeing rents. In fact, I was telling David, another one of our partners this morning, we're buying a property in Fort Myers, Florida right now, where there's literally only four units available for the next 2 months. And where we had underwritten the rents, they're on the 4 units that are available, they're $200 higher than what our model is. And that is happening in a lot of markets throughout the Southeast, where the rents are accelerating to the point where we don't even know where the top is yet.
So Mike, what's the big money from the UK expecting for rent increases over the next few years?
We're kind of in the same boat. I mean, I think we're being a bit more aggressive over the first 2 years of an investment horizon than we've been before. And it really depends on location. I mean, look, we lived through the COVID period where, to be honest, I thought we were going to get slammed from a collection and rent growth when it started, and we saw, virtually no impact to collections, a small impact to vacancy. People, made sure they paid their rent, even to be honest, when there was a moratorium on evictions, right, et cetera. So, even in those down times, people found a way to pay their rent. And I think coming out of this, with all the fundamentals, depending on where you are, there's opportunity to be a bit more aggressive on the first 2 years. I read today that of 150 markets that RealPage covers, 125 of them year over year have seen increases in rent. So through the whole COVID period, wow, only 25 markets were down, and they tended to be, San Diego, San Francisco, New York, Chicago, the gateway markets. Everyone else saw rent increases through the whole COVID period. So we see opportunity to push rents in the first year or two.
So yeah, just you mentioned that, just kind of close up here. We at ApexOne, our entire portfolio, our collections were almost 99%. In fact, our collections through the year of COVID-19 were actually higher than the pre-COVID, because people knew they had to have a place to live and didn't want to get evicted, whatever. They paid their rent for whatever reason. And our occupancy actually went up about 3%. So our rents went up about 3%, and our occupancy, held, strong. It actually increased. So, it was an unusual year, and now we've got our inflation. Well, I want to thank everybody. We've kind of pushed towards the end here. Michelle, it's an honor to have you join the ApexOne advisory team, and good luck with your ongoing business. I see you've got a couple of people asking questions about your service already. So good luck, and thank you for your feedback. Mike, it's always great to do business with Balfour Beatty, such a world-renowned company. It was the toughest interview we ever had to be able to work with you, but we appreciate that. And Tim, it's been a lot of years since JMB, but it's been a great run. And so we hope everybody had a good session today, learned a little about inflation and how it's impacting housing. I think the bottom line is that we think the multifamily sector tends to be a little more insulated from what the increases we're seeing. And we think that there's still good investment returns in multifamily real estate, and some of that driven by inflation. So Michael and Kevin, thank you all very much for this opportunity, and look forward to the next panel with you gentlemen.
Chris, thank you very much. Tim, Michelle, Mike, great job today. Appreciate hearing your color and commentary. And, it's very timely. And this is definitely the best performing place to be in commercial real estate. So we appreciate you guys taking the time and giving us a educational presentation on the things that are going on inside of your minds and how to look at the asset class. Thank
Great.
you.
Thanks, my friend. Bye now.